Welcome back to Am I Catching a Falling Knife, the podcast where we dig into stocks that have seen better days and try to figure out if they're about to bounce back or if they'll keep on falling. I'm your host, Dave, and today we're tackling a big one in the healthcare space, Cigna, ticker CI. This stock has taken a noticeable hit recently, dropping over 10% in just the last 10 days. So, is CI a falling knife that's about to slice us, or is it an opportunity in disguise? Let's find out. The single biggest factor pushing CI's price down right now is the broader healthcare sector's challenges. We're talking about rising medical and specialty drug costs, increased regulatory scrutiny over drug pricing, and even some concerns about customer retention. Now, it's worth noting that Cigna still posted strong Q1 revenue growth, but these industry-wide headwinds and that customer attrition are definitely hitting the stock. So, what exactly is Cigna? The Cigna Group is a global health company, and they basically operate through two main segments. First, there's Evernorth Health Services, which is a big player in pharmacy benefits, specialty pharmacy, and care management solutions. This is their giant segment, making up a massive 80.7% of their revenue. Then you have Cigna Healthcare, which provides comprehensive medical plan services, accounting for the remaining 19.3%. They serve everyone from managed care organizations to employers and even individual customers. Just a note, they're also in the process of divesting their Medicare Advantage business, expected to close early next year. Financially, they're a giant with over $247 billion in annual revenue, $10 billion in free cash flow, and a gross margin around 10.3%. Now, for the big question, what kind of impact is this narrative having on Cigna's earnings? Our analysis suggests a potential negative impact of about 11% on their quarterly earnings, with a confidence range of a 7% to 15% hit. How did we get there? Let's break it down. We looked at how those rising costs and customer losses affect their two main segments. Evernorth, with its huge revenue share, is obviously exposed to those specialty drug costs and regulatory pressures. Cigna Healthcare is more hit by general rising medical costs and customer retention issues. We then made some estimates. Even a modest 0.1% decline in overall annual revenue from customer attrition on their $247.1 billion base translates to about $61.7 million less in revenue each quarter. On top of that, those rising costs and regulatory pressures could compress their gross margin by about 0.15 percentage points. On their revenue, that's roughly another $92.6 million reduction in gross profit quarterly. When you add those two together, that's a combined negative impact of around $154.4 million per quarter. Compared to Cigna's estimated baseline quarterly earnings of around $1.375 billion derived from their annual net income, that $154.4 million hit works out to roughly 11% less in earnings. It's an estimate, of course, because specific numerical data for attrition rates or exact cost increases aren't public, so we're making some educated assumptions based on the narrative and the company's financial profile. So, with that potential earnings headwind, what's Cigna really worth? To figure this out, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow model, or DCF. With assumptions like a growth rate of around 10.7%, a discount rate of 9.5%, and a long-term terminal growth rate of 2.5%, our base case DCF value for Cigna comes in at around $377. But then when we apply the kind of headwinds we just discussed, that estimated 11% hit to earnings, that brings our narrative-adjusted DCF value down to roughly $320.68. The second method is a bit simpler, a PEG-based valuation. This method looks at the price-to-earnings ratio relative to the company's growth rate. Based on Cigna's current PE of 14.6 and its estimated 10.7% EPS growth for the next 5 years, a PEG-based fair value points to about $293.05. Comparing these to the current price of around $267, both models suggest Cigna could be undervalued, even with the headwinds, with the narrative-adjusted DCF implying more upside. Given all of this, and looking for potential entry points if the stock continues to slide, I'd be watching some specific custom buy levels very closely. The first at $240, then potentially $220, and finally a more aggressive level at $210. These would be points where I'd consider if the market is overreacting to the sector's challenges relative to Cigna's underlying value. All right, so there you have it, folks. Cigna, CI. Remember, this isn't financial advice. It's just my take as your friendly neighborhood podcast host, Dave. Always do your own thorough research before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? We'll catch you next time.